Today we're going to talk about Chapter 4, Acquisition Costs of Unimproved Property under the successful efforts. We're going to talk about acquisition costs, impairment, abandonment, and then we have two comprehensive examples. So what are acquisition costs? These are costs incurred to purchase, lease, or otherwise acquire property. You can have lease bonuses through the lease agreement. These are paid to the mineral rights owner, usually the most significant acquisition costs you will incur. You can have options to purchase or lease properties. This would be a stated period of time to purchase. You can have broker's fees that would be paid to landmen or real estate agents, recording fees, legal costs to prepare documents, or other costs. They are going to be capitalized. You're going to debit unimproved property and credit cash. You can also have other items that would be capitalized, such as purchase and fee, internal costs, options to lease, and delinquent taxes and mortgage payments. We're going to discuss each one of these. Purchase and fee is both mineral and surface rights are acquired, and the purchase price is allocated based on the fair market value between the two items. These would both be capitalized. So for example, you might have an amount that would be debited to land. You would also have a debit to the unimproved property and credit cash. The land would be for the surface right and the unimproved property would be for the mineral right. If production is achieved, then the cost allocated to the mineral right would be subject to amortization. You might have some internal costs. These will be associated with acquiring the properties, like accounting. You might have some legal fees. These would be capitalized. And allocating may be difficult, so it might be capitalized on a larger basis. It could be capitalized based on total acreage, or it might be allocated where you would capitalize costs allocated to the prospects and then expense costs not acquired. The journal entry would be to debit unimproved property and to credit cash. You may have options to lease, and these may be obtained with shooting rights that would be expensed as a G&G expense. So the option to lease would be capitalized initially. While you have the option open to lease, the journal entry would be to debit property purchase suspense and to credit cash. So this would be not leased yet. Maybe you're waiting on the G&G results. If you decide to lease the property, you would capitalize it as unimproved property, debit unimproved property, and credit property purchase suspense. Or if not, you would expense it. The journal entry would be to debit surrendered lease expense and to credit property purchase suspense. You may also need to allocate between unimproved property that would be capitalized and expense the portion of the acreage that's leased, if you have some that's leased and then some that's not going to be leased. You may have delinquent taxes. You may agree to pay to get the clear title to the lease. They may or may not be recoverable from future delay rentals or royalties. So if it's non-recoverable, you would debit unimproved property and credit cash. These are going to be additional costs of acquiring the property, so it would be capitalized. If it's recoverable from future delay rentals, you would hold it in suspense until it's recovered. So the initial journal entry would be to debit receivable from lessor and credit cash. When it's recovered, you would debit delay rental expense. You would credit the receivable from lessor. And if there's a remaining amount, you would pay that in cash. Or if the lease is abandoned, you would debit surrendered lease expense and credit the receivable from lessor. Now we're going to talk about the impairment of unimproved property. So you have an asset on your balance sheet in unimproved property, and it must be assessed periodically to see if it has been impaired. So typically this is done on an annual basis. So remember, at acquisition, all properties have potential, so they're capitalized as an acquisition cost. When we assess them to see if they have any impairment or not, this would be looking at our unimproved property accounts. If there is impairment, and some indications of that might be if there's some decline in the value, if there's been any dry holes drilled, so these are unsuccessful wells, if the primary lease term date has expired or is close to expiring, are there any drilling plans on the property? If the value is less than the purchase price on the balance sheet, then we would need to make an adjustment. To record the impairment of unimproved property, FASB allows two categories. You can split your properties into individually significant unimproved properties. These are going to be assessed individually. And then basically you can group the remainder into individually insignificant. So you can put these in one group or different groups, maybe based on some common feature. But a company may have hundreds of properties, so it's good to group the insignificant amounts just for record keeping. It could be based on the year of acquisition, for example, would be one way to group them. It may be based on the success rate, the average holding period, or onshore versus offshore. So the journal entry to record the impairment, comparing it to fair market value, would be to debit lease impairment expense and to credit allowance for impairment. Later, if we actually surrender or abandon the lease, and indications of that would be if we fail to pay delay rental payments, if we fail to begin drilling or production prior to the primary term expiration that's defined in the lease. And we're also again going to determine if they are individually significant or insignificant. If it's an individually significant property, the journal entry would be to charge it against the allowance for impairment on that property. See, we would debit allowance for impairment. We would credit the unimproved property. If the allowance is inadequate, then the balance will be charged to surrendered lease expense. So we would debit the allowance for impairment for the amount that has been set aside in the allowance. The balance would go to surrendered lease expense, and then that should be a credit to unimproved property. If it's individually insignificant, again, these are the grouped properties, and you determine one is going to be surrendered or abandoned, you would debit the allowance for impairment and credit unimproved property. So the first comprehensive example we're going to review deals with impairment and abandonment. This can be found on page 119 of your book. So Tyler Company has the following unimproved leases as of December 31st, 2011. So you can see they're split between individually significant, which would be lease A, B, and C, and individually insignificant, lease D, E, F, and G, for a total of $80,000. And to the right, we see the amount that has been set up in the impairment expense to date. At December 31st, it is determined that lease A should be impaired an additional 30% of acquisition costs. So if we look at the previous slide, the acquisition costs for lease A were $2 million. So we would simply take that acquisition cost of $2 million times the 30% impairment. We would make our journal entry for debit lease impairment expense for $600,000 and credit the allowance for impairment of $600,000. So we have this as a debit. We had a previous amount of $50,000. So the total lease impairment expense for lease A is $650,000. At December 31st, it is determined that lease C should be impaired 40% of acquisition costs. So if we look at lease C, the acquisition costs were $1.3 million times the 40% impairment gives us $520,000. We would debit lease impairment expense for $520,000. We would credit the allowance for impairment for $520,000. C did not have any previous impairment allowance, so this is the total amount in the allowance account for lease C. At December 31st, Tyler Company impairs the individually insignificant group of unimproved properties. The company's policy is to provide at year-end an impairment allowance equal to 40% of the gross acquisition cost of the group of properties. So to determine that amount, we're going to take the $80,000, that is the total acquisition cost for the individually insignificant properties, times the 40%, and that gives us $32,000. If we look at our allowance account for the individually insignificant properties, we already have $20,000 recorded. We've determined we need $32,000. So we're simply going to subtract those two numbers to determine the amount of the journal entry that we need to make at December 31st of $12,000. So we're going to debit lease impairment expense for $12,000. We're going to credit allowance for impairment for $12,000. In the following year, on March 1st, 2012, Tyler Company surrendered lease A. Lease A is individually significant. So we're going to credit the unimproved property for the amount of the acquisition cost of $2 million. Remember, we have $650,000 recorded in the allowance, so we're going to debit that account to zero it out. And the difference of $1,350,000 is going to be debited to surrendered lease expense. On March 20th, Tyler Company acquired an unimproved lease H, paying a lease bonus of $25,000 and legal costs of $1,000. The property is not individually significant. So we're going to debit unimproved property of $26,000. And we're going to credit cash of $26,000. This is going to be added to our insignificant list. On April 13th, Tyler Company discovered proved reserves on lease C. So we're going to reclassify the acquisition cost of $1.3 million. We're going to debit the allowance on lease C. It's no longer needed, so we want to zero it out, $520,000. And the difference between the two is what we're going to capitalize our proved property for, $780,000. Notice, once a property is impaired, it should not be written back up. On April 29th, Tyler Company abandoned lease E. Lease E is one of our insignificant properties. So the journal entry is to debit the allowance for impairment, group basis for $25,000, and to credit unimproved property for $25,000. $25,000 is the amount of the acquisition cost for lease E. On July 15th, Tyler Company discovered proved reserves on lease F. Lease F is insignificant. The allowance for impairment group basis account should not be prorated. So you're simply going to reclassify the $15,000 that pertains to lease F from unimproved property, which would be a credit, to the proved property, which would be the debit. Now at the end of the year, we need to assess impairment on all of our remaining properties. Tyler Company has the following unimproved leases as of December 31st as a result of the previous transactions. So the individually significant lease that we still have is lease B that we're going to be looking at to see if it needs some impairment. So remember, we had lease A that has already been surrendered, so we've written that off, and lease C has already been reclassified to proved. That was done in transaction F, so the only one left is B. On the individually significant leases, E was abandoned, F was reclassified. So the remaining leases are D, G, and H for a total of $66,000. So at December 31st, it is determined that lease B should be impaired an additional 30% of acquisition costs. So we're going to take the acquisition costs of $7.5 million times the 30%. So we're going to debit lease impairment expense for $2,250,000. We're going to credit the allowance for impairment, $2,250,000. At December 31st, 2012, Tyler Company impairs the individually insignificant unimproved properties. Tyler Company retains its policy of providing at year-end a 40% impairment allowance for individually insignificant unimproved properties. So to calculate the amount, we're going to take the amount of acquisition costs that are left of the $66,000 in the previous slide times the 40%, and that gives us a $26,400. That's what we want the ending balance to be in the allowance account. We currently have $7,000 left, so the difference between those two numbers is the $19,400. So we're going to debit lease impairment expense for $19,400. We're going to credit the allowance for impairment group basis, $19,400. The next example we're going to look at in detail is on page 122, and this is an example dealing with the options to lease. So we have properties A, B, C, D, and E. You can see the acreage, and we have the right acquired. We have some shooting rights, and we have some options to lease. Shooting rights are G&G expense. So to record the transactions for area A, we're going to debit G&G expense for $500 and credit cash. We're going to do the same thing for area B. Debit G&G expense of $1,500 and credit cash. On area C, we're going to put this into suspense until it's determined whether to lease the property or not. So we're going to debit property purchase suspense of the $4,000, credit cash. We're going to do the same thing for areas D and E. Property purchase suspense of $3,600, and for area E, we're going to have property purchase suspense of $5,000. Tyler Company hired Sizemore Company to perform G&G work on areas A through E and paid the company $500,000. This is an additional G&G expense. So we're just going to debit G&G expense and we're going to credit cash. As a result of the G&G work, Tyler Company decided to lease the following properties. So for A, we have 320 acres leased. For B, we have 640. C, we have 640. D, we have 800. And you can see that on the area E, we decided to let the option expire. So we are not going to lease that property. So looking at our journal entries. For lease A, remember A and B did not have the option to lease. So we're going to debit unimproved property for the 16,300. This is derived by taking the number of acres leased times the bonus per acre that gives us 16,000. And then we're going to add the 300 legal cost recording fees. We're going to do the same thing for lease B. We're going to take the 640 acres times $50 bonus, gives us 32,000, and we're going to add the 500. So for these properties, we're going to debit unimproved property, and we're going to credit cash. On lease C, we just determined that we wanted to lease 1/4 of the total acreage. So we're going to debit unimproved property. We're going to take the amount of 38,600 as calculated above, the acres times the bonus plus the legal costs. In addition, we're going to add 1/4 of the amount of the property purchase expense that we recorded. This was for the shooting rights, including the option to lease. We're going to debit the remainder of the property purchase expense of 3,000. We're going to debit surrendered lease expense. We're going to credit the property purchase expense to zero that account out, and then we're going to pay the remainder in cash, 38,600. On lease D, we decided to lease 1/3 of the total acreage. So as calculated above, we have the 800 acres times the $80 bonus plus the 750 gives us a 64,750. We're going to add to that 1/3 of the shooting rights with the option to lease that we recorded in a previous slide. That's going to give us a total of 65,950 that we're going to debit to unimproved property. The remainder of the property purchase expense, 2/3 times the 3,600, is going to be recorded 2,400 to surrendered lease expense. We're going to credit the property purchase expense for the 3,600 to zero that account out. And we're going to pay the difference, the amount that we owe of 64,750. On lease E, we decided not to acquire any of the acreage, not to lease any of it. We had 5,000 recorded in a property purchase expense. So we're going to debit surrendered lease expense for 5,000. And we're going to credit property purchase expense for 5,000. Now we have some internal costs. We have some landman salaries and overhead relating to the above acquisitions of 16,800. These are going to be allocated to each lease based on the relative acreage leased. So if we take the amount of 16,800 divided by the total acres that we decided to lease of 2,400, we're going to get an amount of $7 per acre. So we're going to record this to the leased properties, lease A, B, C, and D, by taking the amount of acres per lease times the $7. So you can see for lease A, we're going to debit unimproved property for 2,240. Lease B, 4,480. Lease C, 4,480. And lease D, 5,600. During the second year, Tyler Company incurred and paid the following items. So we have some ad valorem taxes of $1,500. We're going to debit ad valorem taxes expense. And we have a tri-hole contribution that we've discussed in a previous chapter. So we're going to debit test well contribution expense for $20,000. We incur some legal costs for title defense of $8,500. So we're going to debit legal expense for $8,500 and credit cash. And we have a bottom hole contribution. We're going to debit testable contribution expense of $15,000. We have some non-recoverable delinquent taxes on lease A for $2,000. So we're going to debit unimproved property. These are an acquisition cost. And we also have some recoverable delinquent taxes on lease B for $1,500. So we're going to debit receivable from lessor. We have some delay rentals on leases A, C, and D for $6,000. These are an expense, so we're going to debit delay rental expense for $6,000, credit cash. And the delay rental on lease B was recoverable. So we're going to debit delay rental expense for $2,000. We're going to credit the receivable that we set up in a previous slide for $1,500. And we're going to pay the difference, the amount in cash of $500. At the end of the second year, Tyler Company assessed the leases with the following results. Assume that all of the leases are individually significant. So we're going to do the impairment calculation on each property separately. So for lease A, we have a total of $20,540. So you can see that's the initial acquisition costs plus the $2,240, which was the allocation of the landman salaries, plus the $2,000, which was non-recoverable delinquent taxes. A total of $20,540. The percentage impairment that was determined is 25%. So you're going to multiply those two numbers to get an amount impaired of $5,135. For lease B, the total is $36,980. For lease C, $44,080 with a 30% impairment amount. So you're going to multiply the 30% times $44,080. And for lease D, you have a total amount in the unimproved property of $71,550. This is going to be multiplied times the 20% percentage impairment to get an amount impaired of $14,310. Below you can see the journal entries to record the lease impairment expense for each of the three properties, noting that lease B was not considered to be impaired. Early in the third year, Tyler Company abandoned lease C and lease D. So we're going to credit the unimproved property for the amount that has been capitalized. We're going to debit the allowance for the impairment for the amount that was recorded for each individual property. And the difference is going to be debited to surrendered lease expense for each property. And last, in the third year, Tyler Company discovered proved reserves on lease A and B. So we're going to credit the unimproved property for the amount that was in the improved property. If there's any allowance like we had with lease A, we're going to debit the allowance, and then the difference is the amount that we're going to capitalize to the proved property account. For lease B, it did not have any impairment, so we're simply reclassifying from the unproved property to the proved property. And this concludes Chapter 4.